Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for October 2nd, 2023. We are recording this at 1 p.m. Eastern Time, and this is episode number 403. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today I have arranged for Michael Filighera to join us again. You should be seeing his screen right now. And the option professor is back to moderate, so I'm going to turn it over to him.
Okay, thank you, David, and welcome everybody. We have a very active morning here as the stopgap thing that they passed over the weekend has not been voted in with open arms by the public so far. Then the financials are under quite a bit of heat here because the interest rates are spiking, and so are the small caps. Seems like everybody's running into the big names of Meta and Microsoft and Netflix and NVIDIA and all the ones they want to hide out in so far. But with us today is Michael Filighera. He's going to give us a lot of information, and we're going to get into these things because you're getting big moves in stocks, you're getting big moves in oil, you got big move in gold, you got big move in the dollar. That's pretty much the whole thing, and the interest rates. So a lot of things going on. Michael, before we get started, a little background on yourself and about what you're doing at your company.
Sure. Good morning, good afternoon, everybody. My name is Michael Filighera. I am the proprietor, owner, trader, everything within helpingtraders.com and logicalsignals.com. I have been, I started as an options market maker in 1979 here on the Pacific Coast Options Exchange in San Francisco. I've traded here in London on the London Traded Options, European Options Exchange in Amsterdam, and on the DTB in Germany, which is where I got my introduction into electronic trading. I returned back to the US in 1997, came back to San Francisco, and chose to stop trading options when everything did go electronic. And about 2013, I decided that I really was just fed up with volatility at the moment and went over and started day trading in the futures markets, which I've been doing since, and started doing shows with David in 2014, I think it was. So
yeah,
that's kind of my history.
All right. Well, the thing here is there's a couple of things that I know that you are a specialist in, and one is obviously the wave structure. So we're going to get into that, and also maybe some Fibonacci numbers that might come in interesting. So I definitely want to hit those two things in the major markets because, I mean, if the S&P is going to go down, the Nasdaq and the Russell is going to go down too. They're not going to go in totally different directions. You know what I mean? So the bottom line is let's find out here. Let's start out with the stock market. Again, we had a good report from the standpoint they made some kind of agreement. It's a hobo agreement that expires in 6 weeks, but it is an agreement. So people obviously anticipated the market to go up. In fact, last night I noticed it was up about 30 handles. So this movement today is basically showing some significant disappointment. So what are we seeing here on the charts as far as you're concerned? And maybe you could count some waves out and give us some idea of where you think we might be going.
Just to start at basically the same point you did, the thought process, I believe, yesterday was, as you just said, that, the government did not get shut down, therefore money continues to flow. And then that somehow spelled, oh, we're back to being bullish, which was the mistake. And we're now seeing that it actually was the mistake. And the reason behind it is like, nothing's changed. It's just that we're going to continue to keep all of our departments open. But as far as like what was driving the market lower to begin with, did not change simply because we didn't shut down the government. What it tended to really, what came across was like, had the government shut down, it would have forced Moody's and S&P and Fitch and some of the other rating services to downgrade the United States one more time.
And obviously a 6-week holiday is not going to change that. So that's why the bonds are tanking. Also, we've got record deficits that would shock anyone. And that means the supply of debt coming is just going to be off the chart. So you got the supply of debt coming in, and
Yeah.
you've got some people who look like they are inept running the show down there. So,
Yeah.
it's a very bad situation for the bond market right now.
It is, and we'll go to that one in just a second. But to really update the S&P, again, nothing's really changed. Even on my Elliott wave count, I had an alternate to if they really wanted to push higher today and keep that push in motion. It really would have been nothing more than just a bounce off of this low here, and just bringing it up, and that 4 would have moved up a little bit. Because it had additional room where it could have gone up to like 43.
Well, it's oversold, yeah. But the thing is that you notice from March until July, that is a uptrend. And now we are not in an uptrend. So any rallies you have to be suspicious of, because you won't find too many times where all those lines are pointing down and the market's going to magically go to 4,600.
Right. Again, and speaking of the lines, I think that's a good add right here. As we were declining last week and we came into that low on Thursday, I think what was significant on that way down is the breaking of all, at least on the daily chart, the breaking of the moving averages, starting all the way up here with the 50s, and then this is the 100, and then it just really slid quickly. But when it got to the 200, it took a little break. It took a breath, went up, came down, broke, but then it was already set up to recover. It did, but now look what we're doing.
Yeah,
We've come down and we've broken back below them.
Yeah, and that's dangerous when you break the purple line and then you get back above it. When you get back above it, that should be the end of the story about getting back underneath it. In other words, once you penetrate it and get all those stops out or whatever they do when they penetrate these lines, after you get back above it, that should be the end of the story. The fact that we're revisiting it again is obviously very concerning, right?
It's revisiting it, we're breaking it again.
There you go.
So I think that the ganging up in terms of selling on that first break was not as strong as I anticipated. We got the bounce, but now we're coming back down, and I'm suspecting that they'll come in now, and they start now on an Elliott wave basis.
Michael, is that a fib number 4188?
Yes.
So that would be, and that's a 61.8. So that's a strong one. That would be
it's a 1.618, which is even stronger.
Yeah, which means that could be a target.
And I believe that is going to be the target. But it's the target for just this completion of this wave down,
right? Which
completes a minor third. And the minor third actually projects down to 4137. So if
it's a 5-way down, let me just ask questions that people might have. If it's a 5-way down after we hit 4137, does it give you like a couple of waves up and then go back down?
Yes. So what it be here at 4137, what it would be completing is the minor third wave.
Right.
Then we get a minor fourth wave. So just walking the picture up to our upper levels here,
right,
is that overall, starting at that top, what the market is doing, and I need to just go out one more to the weekly chart. You can see there's our all-time high, and this was in January of 2022.
Mm-hmm.
And so we completed all the way up to a supercycle third wave. Now that supercycle third wave started in 1932. So it covers 90 years of a bull market, which contained, folks, this is important, it contained a depression, a world war, the Korean War, the Vietnam War, and multiple recessions. And the great financial collapse of 2009, et cetera, all were within this supercycle wave 3, this very long-term bull market. And that's what we're correcting. More importantly, what we're also correcting is just the massive excess that got put into our money system, the monetary system, by the Federal Reserve and the Treasury. First, to bail out corporations in 2009. Now, we were on a very nice upslope and everything was just hunky-dory until we got a pandemic. Next round, they had to bail out us, retail, us, the common people. If they wanted to keep their economy going, well, we needed to have the money to do it. And many of us were without jobs because we had to stay home, et cetera, et cetera. So here we go again, and we start injecting trillions more. And as you started, Jim, but the important thing that I think people need to understand is that how do we want to deal with $33 trillion worth of debt in a not necessarily collapsing economy, because I don't think that it's necessarily collapsing right now, but we're needing to correct. We're needing to relieve the excess.
You know, the
And that's
fact
the
is
process I think
we
is
aren't
underway.
contracting, and they've raised rates 500 basis points, and auto sales were actually up again. So the bottom line is that they're not getting a lot of action out of their tightening so far. And when I got back from my holiday in Europe, and I went to fill up the gas tank, and I saw a 550 on the gas number. I mean, this is not going into any kind of contraction right now. So that's why these bonds obviously are going to go wherever they have to go. But the point being is that they want this thing to slow down, and they want
Yeah.
everybody to stop spending, and not stop, but I mean, they want to moderate all this stuff, and the moderation is
They
very
need to
hard to see.
balance their own sheets, so to speak. And you're right. The only way they're going to do that is to get money out of people's hands so that they're more into stop spending.
And they have to
Stop.
stop making them feel so rich. So, like the real estate, we're seeing, I think, a 13% drop in sales. I notice in some areas there are some price cuts. So maybe we are going to get an acceleration to the downside phase in some of the real estate when people start seeing the prices trade, when and if they see the prices trade underneath what they bought it for. But that's not happened yet. But again, interest rates are gravity, and they can bring asset prices down over time. So that's why that's going to be interesting.
I always prefer to say that interest rates sit at the top of the pecking order. Whatever happens to interest rates will roll down, as they say, because you have interest rates, then you have the currency, or interest rate, the bonds, the currency, corporate, which is, of course, all of our stocks and their corporations. And then below that is retail, that's us. So it takes a while to roll down to us. And that's where it's now really starting to be felt, because mortgages are skyrocketing. A car, to purchase a car, those rates are now going up through the roof. We're starting to see that if you've loaded up on credit card debt just because you had to, I'm sorry, but you're going to get pinched really hard.
Well, Macy's just had to write off all kinds of debt, so that's already a problem, and it may continue. And then, of course, these student loans are going to have to start being paid back now, starting this month. So there's a lot of stuff hitting the fan. But let's talk about the wave here. If we did go down towards the 41.88, 41.37. What kind of a wave would be a counter wave? Would there be five waves up? Would there be 5 waves up, or just?
No. It'll be a fourth wave bounce. And let me show. This was an irregular. So this was a fourth wave bounce. Well, let me just take it out a little bit. So
And is the fifth wave the acceleration phase? Is that the one?
No, actually, we're finishing out of this particular segment. We're finishing that acceleration phase.
Okay.
The acceleration is going to come within the third wave. And that was it. That was it right now for this particular degree.
Right.
So when we're done, see, again, going back to the degrees of operation, we are in an intermediate first wave down. Inside of that are going to be 5 waves of minor degree. Here's 1, 2. We're getting ready. This down here, if we get down here, that'll complete minor 3. Then we get a minor fourth wave bounce, which will likely bring us back. If we bottom out in here, it will likely going to bring us back to 43.75-ish.
Yeah. And then because on the fifth wave, if you took out 41.37, what would happen?
If you're looking at that fifth wave down, now I'm coming into my next levels.
There you go.
And those are down in here for the fifth wave. And then that completes intermediate wave 1. And then guess what? We get an intermediate second wave. And again, we'll be looking to see it come back up to wherever this minor fourth wave tops out.
Right.
So, it's still going to be push, pull. But as that degree then continues to go up, so in other words, we finish intermediate wave 1, intermediate wave 2, which is still out there to come, then we will go into an intermediate third wave. Now, again, this is the minor third wave. And if we're going to think that the minor third wave went from 4,600, and let's just say 4,100, just to round it off.
Right.
Any of you that live out here on the West Coast understand the Richter scale. So if you have an earthquake that's 4.0 on the Richter scale and the next one 5.0, they're going to tell you it's 100 times as hard. Well, consider it the same. If I take this up a whole degree from minor degree to intermediate degree, it's going to be much bigger. So this drop is going to be much, much more severe. And now we got to deal with the timing of the whole thing. So I think, right now we're rolling into October. I think we kind of come into our low for minor wave 3, and minor wave 4 will start to push us into earnings. So you see the nature of that minor 4 will be an A, a B, and a C. That gives a lot of room for
let's just talk
surprises.
I want to bring something in here. The general thesis now is that we are going to maybe have a rough week or so here in the beginning of October, and then when earnings start with JP Morgan on October 13th, the earnings are going to be beating, and fourth quarter earnings are going to beat it, and so we are going to have substantial rising in the market as we go into the end of the year, because they say statistically, if we are up over double digits in the first half of the year or the first 3 quarters of the year, the fourth quarter is a strong quarter. So there's a lot of seasonal thing that's being thrown around, and the earnings going to be very positive is being thrown around. And so there's a very large belief that the market is going to have a fantastic end of the year. Now,
and I agree. Can I ask you a question?
like I say, that obviously all could happen. So you have to have alternatives if markets start doing different prices, like obviously we start taking out 44, 44.50 and something like that. You have to change your tune. But the point being is maybe that end of the year positivity may be coming from the 41.37 level.
Yeah, but I don't think, it could, but what you're presenting everything, and it's all valid because that's what's being stated, that's what's out there and being talked about right now. But it's what I would call the status quo. If this happens, then that should happen. The if-then statements come in. And I think what doesn't get played out is I am also hearing analysts and others talk about, the interest rates, they're going to start to chip away at earnings. They're going to start to chip away at these large corporations. And the belief right now today is like, oh, no, it won't. So we're going to go shift all our money back over there in hopes that even if it does go down, they'll still do better than the market. And so that, with that concept in mind, I think it just presents a narrative that is not healthy, because the reality is interest rates, folks, are not stopping. And I don't think they stop until the end of the year. We still do have at least one more rate hike before the end of the year. We still have to deal with a government that agreed to pass a budget, which now they're taking it back. We're up in the arms. What happens if that doesn't happen? What do we do with 45 days just before the holiday season starts, if the same group that just will not cooperate or go back on their word stands firm and says, okay, shut it down? So again, we do have that side of the story to deal with as well. But I think in just terms of what Elliott Wave is telling me, Elliott Wave is, if we're finishing this third wave and we get the fourth and we start to come back down, that's going to tell me a whole lot. If we finish this third wave and it starts going up and it doesn't stop, that again tells me a whole lot, just like you're saying. But
Well,
right
if
now,
everything if
that's not
everything
the
were to break
expectation.
their way, which would be the bulls' way, which would be the yields start backing off because this is kind of a blow off top in yields. If the oil prices, which reverse today, reverse some more, if the government gets an agreement that they can live with, and if the dollar backs off of this breakout above 106, then there's a lot of thing. And of course, the earnings come in and totally blow out and give good guidance. These are all things that obviously would change the landscape quite a bit. And
Absolutely, it
that's
would
why
change the
that's whatever
landscape.
trading you do, you always have to have respect for the other guy's opinion, or else you're going to lose a lot of money.
I agree with that as well. I think that, you always, if you're going to play it from the short side, you must have a outlier hedge on that's going to protect you should they come in to say, oh no, you were wrong and we're right, and here we go off to the races. Or you have to be very nimble and be able to switch it and flip around. I do agree with that. But I just
By
think
the
in
way, one
terms
last
of
thing
the
for option people out there, the VIX is up against this 17 to 20 area. If we
yeah,
start seeing a 21, 22, 23 VIX, then we're going to have some problem, because that would be breaking out on the VIX. And if the VIX ever goes to 30, there's a big mess out there. So I would be watching the VIX very closely and see if this 20 area holds. And if it does, then you might very well be looking at an opportunity that's reasonable down here for a rebound rally as you go into the end of the year. But if we were to break above 20 and start moving towards 25, and God forbid if you're bullish 30, then an acceleration to the downside with some event has probably occurred.
do you follow the NASDAQ VIX,
No,
VXN?
no, I
It's
follow
at
the VIX off the
22.
S&P. Yeah,
The NASDAQ volatility index is at 22.
I got you.
So I mean, all relative. I agree. The Nasdaq, the volatility in the Nasdaq is greater than the volatility
Yeah,
in the
you probably have a
S&P.
higher bar to make that one look like it's bad.
Exactly. That's what I was going to say.
Yeah.
Because it's like if people going, oh well, if that volatility index is at 22, okay, well that's 4 points higher than the VIX. I was
You can
like,
see
yeah,
you can
but
see that the people feel like hiding out in tech is the where to go, because the green on your screen on the left is your Meta, your
all tech,
Microsoft, your Nvidia, your Netflix, your
AMAT,
Amazon,
AMD, all
Google.
of it.
Yeah,
Yeah,
they're going to go, and if we're going to go down on the ship, they're going to go down on the ship that seems to have the best balance sheets and the best
right.
you
Right,
know
exactly correct. And that I think is a play that many asset managers will do.
yeah,
That they have to put the money to work. They
exactly.
have
And
to do these things. And
you
now,
can, by
guess
looking
what,
at your
folks?
screen there on the left, can't you just see them running into the liquid big
Yes,
names with the best balance sheets?
yes, I saw it this morning.
Yeah.
Absolutely, yeah, without a doubt.
And they
I
don't want any
watched them
part of
take.
small. They don't want any part of small caps or financials. So they're obviously very concerned about
Right,
the interest rate spike,
but
and the
I
fact that
think
small caps would get damaged with a slower economy.
right, and I think what becomes important, and this might be something that you could comment on as well, is that the over evaluation within the Nasdaq. Just on just I don't know what the PE ratio is in the Nasdaq these days, but stocks, in my view, stocks are incredibly overvalued, which puts the pressure back on the company itself to continue to blow out earnings quarter after quarter after quarter,
Right.
which means that for a company like Apple, every single product has to be purchased over and over and over again, and there can be no slip ups in between. And so I
That and the
think
fact
that
that we're still well underneath that 200 high point, that's for sure.
yes, but the fact is that they ran in and they ran this stock down to 168 last week and then ran it back up to 174. And again, this is going into your backyard, Jim, that what I find so often, particularly in the Magnificent Seven, which are from, all those NASDAQ stocks,
Which is where the money's going.
that we have such an influx into the options trading. And because there, it is the premium game. And that's volatility, folks. Volatility in options translates into premium. And if you are a dealer, which means you're making that market, you live to sell premium. That's how you make your money. And so as long as that game is in play, they're not buying or selling Apple based on what their opinion of Apple is or Apple's future. They're buying and selling Apple based on what the premium is being paid for inside the options. And as long as that game ain't going anywhere. I mean, we can just take a look at, and I could pull it up and don't need to do that. So the amount of open interest and the amount of daily trading, and now add into that in our indexes, we have 0 DTE options, which are 0 days to expiration. Those are the most popular options.
Well, again, it's very
trade.
simple why they're popular, because I've been participating in these short-term options quite a bit.
Great.
You get
Go ahead. Yes,
please.
please.
Hey, listen, you get leverage and you get limited risk. And if
Yeah.
you and basically, like I've been very focused on, you want to throw Exxon up so I can show an example of why people would be
Sure
doing
will.
this? Because again, first of all,
Do you want me to do Exxon options or just
yeah, no,
Exxon
just
stock?
do XOM. I just want to explain why, people might find this interesting, because I've
You're right,
definitely
it's
been
Exxon
finding
Mobil
very,
these days.
yeah. Okay. Like in the last week, can you get something shorter term? Like, say 1 month? There you go. 1 month, maybe?
That would be a 4-hour. Let me go to the
that it?
4-hour chart. Yeah, this is January.
All right.
So
Well,
I can go.
no, that's, I'm talking about a 1 month, meaning just a 30-day chart.
I don't know if they give me that choice.
You got 5-day, 10-day, 20-day. How about 20-day?
There you go.
There you go. All right. We've had a couple of times here in the last couple of weeks where this gives you an example, where you've seen the market come up to a neighborhood, like it was at 118 and change, and then you see the RSI is definitely lagging. And so if you just look at short-term options when it's up in that 118 at the 117 mark, these options are underneath $1. And 117 minus 114 there is like about 250. So the percentage move can be tremendous on these short-term options, and the risk being fixed and relatively low price makes them a tremendous gamble. Up here, we just saw it last week again. You have a double top up here, and look at that RSI lagging. So you take your shot at the 118s, and look what you're doing today. You know what I mean? So short
14. Yeah.
Yeah. So these options are now $3 in the money, and they might have cost like under $1. So there's people doing this because if you can find turning points, the options are not going to cost you that much money if you're wrong. And if you're right, you're going to get tremendous premium expansion. And again, your risk is limited. When you do the day trading with stop losses on things, the thing could gap on you and your risk could be way beyond what you thought. So I find that for people who, have speculative capital that want to just take relatively small cash risks, but have leverage and potential large gains, that's why these things are popular. Because again, the math works out pretty darn well, as long as you can find some winners. And that's why when I'm looking at this stuff, I use a combination of moving averages and the RSI, and I've been very, very happy with how they've worked. So
Agree with everything that you're saying, and thank you very much for including that today.
yeah.
Because the next thing that I want to make reference to, we are now talking about a bullish or a bearish market, and et cetera, and how is the bull market going to keep going, how bear market is going to keep going. And what Jim just presented has nothing to do with being bullish or bearish. Nothing.
Oh, no, you couldn't.
So that's my point.
Yeah.
That's my point. When we're watching these things trade, these are not making bullish or bearish statements. So how can we relate that to how do I want to really formulate something in the S&P or in the NASDAQ and declare that the next quarter is going to be bullish? or
Yeah, I
these
mean,
earnings are going to be
these
bullish.
are
It's like,
these
it
are
doesn't make any
reversion trades,
difference.
right, Michael? They're reversion trades. You see up at 120, the
Oh
moving
yeah,
averages are
I
here.
agree.
Yeah, so
I
this is
agree.
the third. This is the third leg on my bar stool. Besides RSI and
Yeah,
moving
I like
averages,
that.
the other one is reversion to the mean, and you can see it
Absolutely.
happens.
Yeah.
It happens quite often. On the Wednesday, and around the week before, it got way
Yeah.
away, comes back.
Uh,
So
Absolutely correct.
yeah,
And then
that's
on
why
top
it's
of that,
not
in
like
volatility,
you're not saying you're bearish on oil, you're bearish on Exxon. What you're saying
right,
is that there's been a little bit of a overdoing it on one side or the other, and
right.
that volume will dry up, and the RSI is kind of telling you the volume's drying up, and you're just playing for some of these people to either take profits or some people to start shorting a little bit as a speculative thing and bringing it back in line. That's all you're saying.
And yeah, I agree. I agree with you. But my point back is that what really trading becomes is not trying to figure out direction as much as what you're talking about. Okay, reversion back to the mean, or what I might talk about in the volatility, because when they're playing volatility, there's the dispersion trade.
Yeah.
And that's a whole super big money making trade that's being put on. And again, has nothing to do whether the market's going to be bullish or bearish. The outcome of the trade is going to be affected by market movement. So again, what my point here is, and Jim, your illustration was perfect, is that as a trader, you go and you trade because your objective is to put on trades that earn you money.
Right.
And not necessarily going, well, I'm going to do it the old-fashioned way. I'm going to buy Apple because I believe in the company and they always have good earnings. I'm going to buy it and hold. Why? Why give up all this opportunity? So it's like, if you're really, really interested in trading, you're going to want to get a hold of somebody that's going to be able to teach you some of the intricacies of how to move in and out of the market using options and the underlying, et cetera, and trade. That's kind of my point. But and your examples illustrate that point to a T.
Yeah. And that's why I'm really basically illustrating why the popularity of short-term options are there.
Yes.
Because
Yes.
again, it's I also think it might be the return of the penny stock crowd. In other words, why would you just do penny stocks that may or may not ever work when you can basically, in some cases, buy options on major companies for peanuts for a week or a few days, and if you get some kind of a correction, underneath $1 trade or underneath $2 of risk can expand dramatically because you're controlling 100 shares of the stock on every one of them, or leveraging 100 shares of the stock on every one of them. Hey, I don't want time to get away from us here because there is a lot of different markets. We looked at the stock market, so we get the idea it's under pressure, and we get the idea that obviously it has maybe a little bit more to go on the downside, but it also is susceptible to have a rally because we are in an oversold condition. So it's kind of a little bit of a tough area to make big decisions.
Limited rally, but yes, a rally nonetheless.
Some people might say it's too low to sell now, and some people say it's too low to too weak to buy. So it makes for a tough racket. Obviously, if you were going to do a lot of business in stocks coming off of 4,500, 4,450 was the better place to do it if you wanted to, sell it. And then for buying it, it may hold this 4250.
You'll get your opportunity. Yeah.
Yeah. Let's talk about oil. Let's put up crude and find out, did oil peak here at 91 because the whole world thinks it's going to 100 now?
Interesting that you pull this in. Let me go out to, I think that's least on my
because listen, they're piling into oil stocks, and the oil stocks really have not moved like the crude has, which is either telling me one of two things. Either the crude rally is a fugazi and it's going to start fading. Some guy from Citibank or something like that, Ed Morse, was saying that he believes we're going to see a 70 print next year. So that's certainly different than $130. And then
it is absolutely. Well, here's my chart. These are the fibs. Again, no Elliott. These are just pure fibs and charts. So
this is on crude oil, or what is this on?
This is crude.
Because we're not at 115 when we were at 115.
We're not at 115.
This is going back years. I got you.
Yeah. This is the high, that 130 high that you just spoke of. But what I'm bringing into focus is October, right? We're in October.
Yeah.
Here's last October. And this is just charting and looking at what the market did and where we are now and what could happen next. So crude last October topped out between 91 and 93. In fact, it topped out at 90, 93, 98, up there at that high. And then the next 6, 7 months, actually longer, 9 months, straight down to 65, 64. Then what do? We start to rally, and now we come right back in. And where did it peak? Right. See, I just wish I could let me see if I can pull this up a little bit. Look at that. Spiked up last week.
All right, here's what I'm gonna, if I was a viewer, here's what I'd be asking you. First of all, last year we were in a primary downtrend, so obviously re-engaging into a downtrend would be easier than what we're doing now. Could we look at a 1-year graph to see if there's any RSI divergence that might be telling us that this is a high point? Because obviously this has been in an uptrend, which is a different environment than a year ago. So let's take a look at the 1 year and see if there's anything. Yeah, there you go. You see the high point there, you had the RSI, you made a new high to 93 and change. Where's RSI? It's lagging. What happened since? We're reverting to the mean. It's exactly what I try to talk to people about when and if I can get them on the phone. This is the kind of stuff that's very helpful, because if you're looking at the kind of stuff that I use, you would have been selling it all day long at 93, 98 because of that divergence there. And then basically, and also you could use short-term options here because everybody is buying calls, and the short-term options might be quite cheap, like they were on Exxon, and that's how you can take advantage of it. You know, the Big Short movie had a couple of guys in it, and this is how they were talking about how they made their money, is that when everyone thought that something couldn't happen, obviously the options are going to be very cheap on the other side. And if you can find out a reason why that could happen, like the divergence there, you can pick up options at a very cheap price and catch a nice ride. And this is also a reversion to the mean as well, right?
Yeah. Yes. But again, I'm not putting up Elliott. I mean, the fibs are there just to kind of show how high I thought the market might be able to get.
Yeah.
You know,
no, well, that's a logical place where, you're not only looking for just one thing. You know, if you can find 5 reasons why something would work, that's not bad either. And so the reason that you showed that neighborhood could be a problem, that's a great thing. And then if you have a confirmation like the RSI running out of steam, well, that's volume running out of steam. And when it runs out of steam and it's this far away from the averages, reversion probabilities, in my opinion, go through the roof.
Right. What it's now done is come down, and this is all initial. This is our initial drops.
Yeah.
And it's sitting at the daily 20. That's that dark blue, the daily 20 moving average. What's next? We got what's sitting right under this channel line, the bottom channel line, the 50. The 50 is still pointing straight up, basically.
Yeah. Which means,
so
like I say, which means I wouldn't be counting on the 70s or the 60s anymore, but certainly counting on going back towards 89 worked out, and possibly, if things unwind further, going towards the 84, 83, 85 number, right?
Got support. I have the 200s, and I got a channel line right there at 83.20. So yeah, that would be good. But if it breaks, so who knows what the future is going to hold? No, who knows what OPEC may or may not do. So we don't. But there's a continuation factor in here as well. If it is going to repeat the process of what it did, and what you're catching it is at the top or the start of the downtrend versus a continuation of the downtrend as it did in October of 2022. So this would be the start of the downtrend, which eventually may end up down here. I don't know. But, you certainly, there is trading opportunities in crude oil right now.
Yeah, there's evidence of a reversion to the mean right now. The other stuff, there's not evidence of that right now at all.
And I think that's about as far as we should go.
All right. So I think we covered that, because tick tock. Let's talk gold. And I've been very, very adamant to people to stay away from gold like the plague unless we can start closing above 1975. And it has not been able to get above 1975. And now, in my view, it's in Crunchville, which is between 1800 and 1850. And so
And
what
for
is
good
that?
reason, Jim. And you know as well as I do that the gold traders are glued to the price of the dollar, to where the dollar is right now.
Yeah.
They're glued. And the dollar is threatening 107.
Yeah.
Well, sorry, gold. It's straight, and you can see what is happening. It broke 105.
No, and
down.
the interest
Broke
rate
106
and the
down.
interest rates are trying to do something that it generally is successful at. And the interest rates are very successful at bringing asset prices down if they are high enough and if they're up there long enough. And so basically, that's how they broke the gold fever back in 80 is they obviously did things with the interest rates. And rather than gold being at 850 on its way to 1600 back then, it had the nice big correction. And then on the silver, rather than going from 50 to 90, it went back to like 10 or 12. Of course, making the Hunt brothers sell everything they own helped as well. But the thing here is that now it's getting a little bit oversold here on the RSI down here. So this is a neighborhood along with the 1840 number, because on my work 1840 area is real big, and your work it looks like 1851 is kind of big. So if it
1851 is very
if
big.
it can hold this 1840 number, could it have a bounce back? And the answer would probably be yes. But if it breaks, I see you got a 1796 number. I've got a number in the 1500, 1600 area that if it really unwound, it could do that as well. On your longer term graphs, do you have anything, like a?
There's your 16. There's your 1600.
There you go. Yeah.
Let me go to a 20-year. I
That's where
I'd
mine's on the
have to
20.
really open this thing up and throw some different fibs on.
Yeah.
But yes, yeah, I mean, it is not a decline that you don't want to be messing with it.
No.
So I mean that is very, very clear, and I agree with you to be careful, because if this does not hold, we might get a rally, because that's what we're seeing in the RSI.
Exactly. Well, it's
And
oversold down there. Yeah. Yeah.
Yeah, and we might get a little bit a rally back in gold as the RSI starts to perk its nose back up. But I think that even if I'm just taking it from here, 1, 2, 3, large third, small 4, still got a 5. So your 1840 stays in place as a buffer,
Right.
but a strong break there then takes us down to 17 or 1800. Basically.
Yeah, like I say, they could run the stops under 1840 and take us down to 1796 and then have that, what do they call it, counter trend rally that happens, right?
Yeah, absolutely. Because then this pattern is going to be more complete. It'll be more complete here.
And it'll
And
be
then more
screaming
complete all the
reversion
way
to the
from
mean. It'll
there.
be screaming reversion to the mean, not unlike NVIDIA.
Absolutely.
NVIDIA was screaming reversion to the mean at 500. I don't know why anybody who bought NVIDIA at 500 just didn't have a chart, because, and like I say, you don't really want to get involved in your initial sales when it gets this far away from the moving averages. You want to possibly look around to see if it hits a low, has a bounce, comes down and makes a new low or hangs around the low. RSI shows you a divergence, then you take your shot, But
it's all good.
What about silver? Let's look at silver, because a lot of people think that is going to be the better one to be in when and if it turns. But this is falling into the abyss a bit, isn't it?
Very much so. Very, very much so. These are upside fibs. Let me get rid of this one.
But this is a classic example of why you don't want to catch falling knives or hold on to things that are making lower lows or anything like that. Because, the only reason you're in these metals is if there's going to be this big move up through 1975 into 2500 or whatever, and silver breaks above 26, and all of a sudden we're going to be at 30 or 40. That's when you want to be in those metals if you're holding them. And that's just not the environment right now.
Very quick fib, which just shows that connecting the high to the low to the next basic. Well, actually, no, take that back. I'm going to do one that's going to be better. I'm going to go from here to, come on, get it down there. Thank you. That one. And then up to here. So that's high to that low, back up to the high to show me where can this thing bottom out. And you see it's already slid right past the 100%. That brings me here. 1.618, 2023. That's likely next. And it seems to be in a hurry to get there.
Yeah.
Right now. Silver is down over $1 today, Jim.
Well, I'll tell you
huge.
something, because again, they're basically saying that the Fed will win. And what does a win mean to the Fed? That means the unemployment rate goes back into the fours. That means that the price of things go down. That means consumer spending goes down. That means prices moderate. Probably real estate has a correction of 10 or 15% because it went up 40% at least. So those are success stories for the Fed. And if that's the success story, then these metals are going to have a tough time. Now, here's when I would remember to buy these metals. When that Fed finds that the pain is, and this might not be till 2024, but when the Fed sees the pain actually occur, and I know the remedy is print the money again. When they do print the money again, and if you can pick up these metals at these discounted prices, they, in my view, will fly when that happens.
Right.
So I would not abandon the metals, but I don't need to be, on something that is decelerating and is contrary to the environment we're in. But I would not dismiss these things because I've been in long enough, and you've been in long enough to know when they switch gears and they get off the hiking interest rates and collapse the money supply and go back to their normal game, which is easier money and printing money. And with the deficits out there, that is coming, I'm sure. When it does come, these things at a discounted prices could be one of the buys of a lifetime.
It depends on as an investor, what type of investor you are. If you're an investor that you're picking up instruments or product that is a storehouse of value, or you're doing a longer term protection of wealth, then your interest is going to be in gold and silver.
It's hard though, when your asset is dropping, you could do dollar cost averaging, but since we have no idea when the rain stops, it's kind of hard to it's hard to dollar cost averaging falling knives. But if that's your
right,
game,
and you've got to stay in for a very
you're getting
long
discounted prices now, right?
Exactly. And but see, again, that's just if you are really looking at a long-term view and you're 35 or 40 or even 50, and you're like, okay, I'm now projecting out another 25 years. Well, yeah, you could dollar cost average, but do it correctly. So in other words, don't do it every 10 cents.
And consistently too, probably.
Right. So you're putting X amount of dollars into that type of an investment.
Let's hit the US dollar here, the Dixie, and give people a little idea of what the dollar is doing.
Surprising me. That's what the dollar's doing, is surprising me.
Well, I mean, listen, these interest rates are getting to be where there's a big yield advantage again. I mean, forget about the yield advantage with the Japanese yen, but it's even way bigger than Europe. And Europe may not be able to hike rates that much more. I just came back from there. Everyone's complaining about inflation over there still, but the economy is definitely slowing. After summer, all the tourist people are gone. That's a lot of revenue to them. And then these oil prices, because they're a net importer of oil, is a killer for them. So the bottom line is there's a lot of great reasons why the dollar has been rising. And of course, reversion to the mean, if you can go back to when it was like 115, you see there was a lot of moving averages way down at the lower area, longer term, and you're like on a 20-year graph. And all it did was come down to the reversion. And now it's been going up since 99. And how many people were bearish on the
long-term chart? Okay, well,
go to the 20-year, and you can see when it was way up.
There's 2008.
I'm talking about like when it was way up at 115. Yeah. Okay. So you're way that number, that letter A. Yeah. When you're up at A, can you see how far away you were from the moving averages? Well, that's why it's like NVIDIA at 500. They're screaming reversion to the mean. And basically you can see it held that 9,900 where the yellow dotted line is. And then you got a little penetration. But like we were saying about today's action on stocks, if you get a penetration, but the line's still rising, you don't have to respect it. And if it gets back above it, that's a tremendous buy. But here in the stock market, we weren't able so far to get back above what they dipped under. So that's why it's a little bit dodgy. But here you can see once it got above it there, it's been going. Now it's getting a little overbought again, huh?
A little bit, but this is a weekly chart. But I wanted these fibs coming up inside here. I need to let me get rid of these because they're kind of in the way. These are the more important. This is covering the rally. And what we're looking at is I'm comparing this rise, even though that did make a new low. So on an Elliott basis, it's an ABC, but it's an irregular B wave. So the normal stopping point is 1.618.
And this is just a running of the stop. This is a running of the stops that only lasted one day. That's why when the moving average is rising and the violation of it is very brief, it's one of the better buy signals in my view, or sell signals, no matter what direction it's going in.
We may just, look how close we are.
Yeah.
The high is 106.936.
Yeah.
107 is just a little heartbeat away. And,
exactly.
And yes, this is even further. Yeah. But fact is, it's just like pop and we're there. So but I think what comes next, and again, it is going to be a lot is dependent. The Fed's there's so many moving parts to get the dollar from where it is to where it should go. So,
well, to be honest, it looks like it has just resumed the uptrend. And again, Larry Summers put it best, and I was over there. I'll tell you my opinion. Your choices are Europe with the euro, and he calls Europe a museum. And as I walked around to all these towns in the south of France, if it wasn't built by Louis XIV, it didn't look very nice. And they're heavily onto and then they say Japan is a senior center, and because their demographics are terrible. And then China's a jail. So where are you going to go use as a currency, that you can trust? You're probably going to stick with the dollar, and that's why it keeps going back up, because your choices of those other ones, are not attractive.
Right, but in the meantime, the dollar up here is not doing any favors to the United States, to our markets, to our bond market, to our all markets. I just think there's a heap of hurt. And the other thing, here's a question that I wanted to ask you. We have a few minutes. The pressure that's being put on the economy by UAW strike. By now, we've got hospital workers going to be going out on strike. We have
because there's a big revolt on, they want the wages. Yeah, go on. There's a very common sense revolt. If you're going to make the price of everything go way up, you're going to have to pay me some more money. You don't have to be from Harvard or MIT to figure that one out. So that's what they're doing. Now, those spreads are tightening a little bit, because the UAW thing used to be 40 and they were offering 20. Now it's 30 and 20. So they're probably close to getting some kind of a deal done. But it's a deal where wages go up. And wages going up, because people,
all inflation, right?
Yeah, people spend whatever they make. Apparently, I mean, I have a different philosophy, but people in this day and age, they spend whatever they make, and if they spend more than they make, just like the government, they put it on a credit card. Now, that works up to a point, and that point, seems to be a little bit close here. So,
because interest rates on cars just went up over 30.
But then auto sales were up. So go figure that out. Auto sales are up. I have noticed that the used car prices seem to be being discounted a bit. So there, like I say, there are some breaks in the action here. Real estate sales are definitely drying up. So there's some breaks in the action.
When? Though?
Huh?
Auto sales from which quarter?
Well, no, just last month.
Okay.
Last report.
Report.
Yeah.
Okay.
Yeah. But the used car prices definitely have come down, which they should have done. Whoever heard of used car prices rising? Yeah.
I know, but one last chart. Just let's look at the 30-year bond. Just because this is, I'm going to go to a little bit longer term. There's the all-time high. So basically, folks, all we've just really done is we're coming off of and finishing up a 5-wave decline, and we're getting close. We're getting very close. But here's the zones. Here's the cluster of support. We're sitting at 112.
Yeah.
I'm really expecting this to drop to the 110, 109 area. And if that doesn't hold, it's going to sink like a stone to 106 to 102. This is the 30-year bond. The 30-year bond hasn't been down at these levels. Let's see how far back I can get this thing. This is 2000. This is 2008. All right, 2008 is the last time that the bond was at 104. So again, we're getting into what most people would consider uncharted territory. I was trading here. So I remember bonds at those prices.
I would say that the RSI is indicating that we are in a possible last phase of the selling, though, because we're making new lows and the RSI is not. So I'd be keeping an eye on that one.
And I'll tell you what, I agree with your RSI analysis.
Well, that doesn't look as good.
On the basis that what I think we're finishing up is, again, an intermediate A wave, and what it's going to produce is an intermediate B wave counter trend rally. What I want people to keep in mind, counter trend rally, still going to be kick your butt, still going to be tons and tons of trading to do as this thing rallies, as the bond prices rally and the yields or the rates come down. There'll be plenty of trading, but what will then follow that is an equivalent move, but even more severe than what we've just seen finish.
Can you put up the 1-month graph or the 20-day graph on the S&P? I just want to see if there's a divergence that might be tradable here today, because we have made some new lows, and I'm just trying to see if there's anything. That's pretty far back. 20-day, 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 20-day. Is that all you got for 20-day here?
Well, here it is, September.
Okay.
September 1st.
Okay. Yeah, there's not much there. There's not much there. So, you're making lows and the RSI is not telling you anything. So there's no indication of a pop there at all. My system I have is,
or even my 4-hour might show you a little bit different.
Okay.
No, yeah.
Let me see here. Yeah, you got a low down there, and then yeah.
This is mid-September, so I got you more, 20 days.
20 days, yeah.
No, nothing really.
Yeah.
That happened last week.
Yeah. Well, last week, yeah, there's not much.
A little bit
Mine,
there.
the one that I use off bar chart seems to be easier for me to read than others. That's why people say, what platform do you use, this and that? I find some of these charts more difficult for me to read, just personal, than others. But we are going to be hitting the top of the hour, so I want to have opportunity for you to tell people exactly how you can help them and what you can do for them, and then I'd like to explain what I do as well. So can you give a little update on what you're trying to offer?
Right now, again, what I do each and every day is I provide an update on the S&P 500 and the NASDAQ 100. That's an Elliott Wave update, and that's on YouTube. My channels are Traders Helping Traders on YouTube. And if you go there and you go Traders Helping Traders and my name, you'll find I have 2 channels, and both of them have the same information on them. I also have a trade room that is, I use it more for coaching. So if you had an interested in coaching, and that's about trading and how I trade and how you want to trade and what your goals might be, et cetera, or working on different things like mindset and things, then I would offer coaching, and you can always contact me, or you can go to logicalsignals.com and then look up the coaching, and you'll find some different information there. Always contact me at michael@mjf1partners.com, and I will respond. And so that would be, if you had an interest in my trade room, if you had an interest in coaching, or you just have a general question.
Perfect. As far as Option Professor is concerned, you can contact me at optionprofessor@gmail.com. OPTION professor timingresearch.com. And here's what I'm doing. Rather than discussing, putting money up on this, that, or the other, I am at my discretion talking to everybody I speak to, and I'm allowing them to receive my information, 6 PDF reports, and have a 1-hour meeting with me where I show you how I use RSI divergence, moving averages, and the reversion to the mean, plus short-term options to try to trade. And then after we have our session, if you're satisfied that you've had value, if you're satisfied that I've helped you become smarter, then obviously you can pay. If for whatever reason you don't find that you've had, you don't have to pay. So it's a very good opportunity to find my information out, for me to show you what I do. Obviously, I believe I'm going to give you way more value than any cost. So I'm very confident that that'll happen. But for whatever reason, if it doesn't happen, you don't have to pay a dime. That's about as good an offer as you're going to find. And I've been doing this for decades. So the bottom line is optionprofessor@gmail.com. You put your contact information, I call you back, and then we go from there. We can also look at your markets to see where you've made your mistakes and see if my stuff would have corrected those mistakes. So a lot to learn. Optionprofessor@gmail.com, or there's the website as well if you want to put your information in that way as well. Hey, Michael, this has been great. We're going to do it again, of course. We've been doing it for so many years, so we're going to get back at it. So thanks for being here as well.
Thank you.
You bet. And I'll send it back over to David.
All right. Thanks, guys. Great discussion today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube. Also, you can find these on your favorite podcast app or on Substack, or you can just go to TimingResearch.com, and the archive for today will be posted soon. Also, all the past shows and events are archived there permanently as well. So I just want to thank my guests again for today. Michael Filighera of logicalsignals.com and tradershelpingtraders.com, and the Option Professor of optionprofessor.com. Thanks, everyone.
Thank you, David.